All right, with food prices and gas prices at record highs, housing affordability challenges, the recent increase in interest rates, and rumor of more to come, can we afford higher interest rates? That's what we're talking about today. So let's get started. So I'm here with Zach Lafudo. Did I say that right?
Correct.
All right. Mortgage agent with Dominion Lending Center, Estate Mortgages. And we're going to talk today about the Bank of Canada's recent hike of 50 basis points on June 1st, 2022, and rumors of more hikes to come this year. So let's talk about first, how does this look for most Canadians in terms of monthly payments?
So if you're on an adjustable rate, and that goes for line of credits, your mortgage, if it's an adjustable rate, a car loan, if you have an adjustable rate there, anything that's tied to that prime rate or the bank's prime rates for lending, it is going to increase your payments. So about 24, 25 bucks a month per 100,000. So you're looking at 120 on an average mortgage size of say 500K. So you just have to budget, and it wasn't not expected either. Like maybe at the start of the year, we had no idea how fast or how quickly they were going to increase. Now we're getting wind of it before the increases are happening. We're definitely going to see more throughout the year, budgeting for a couple more, at least with my clients. And again, no crystal ball of what they're going to do, but at least saying another, quarter point here, maybe another half point increase, as soon as the next couple months as well. So we're definitely not done with these increases, but budgeting and planning for it ahead of time, you can be prepared for them now.
Yeah. So I'm sure if I was a buyer, I'd be wondering how is that, or maybe they're not wondering, they need to know, how is that going to impact their purchasing power? And with housing prices, they've been really high, and housing affordability has been a huge issue for a lot of Canadians, and especially here in Durham region and GTA. So what are you seeing in terms of how that's impacting their pre-approvals?
So if you're taking a variable or adjustable rate, they're still low enough that you are not impacted in any way yet, because we're still qualifying at 5.25%, right? The stress rate. Now, if you're going with a fixed rate, we need to take the contract rate plus 2%, which now is higher than that 5.25. So fixed rates, you are impacted. The variable and adjustable, we're still not high enough now that it's needing to qualify higher than the 5.25 and put that plus 2% on. So you're not impacted, but what is impacted is your budget, right? Okay. Can you afford that higher interest rate? If you had locked in, I was talking to someone today, say if you bought $1 million home in pandemic times or smack dab middle of pandemic, and you had an $800,000 mortgage, you locked in at a 2% rate there, like the fixed rates were down a little bit. So say you locked in at a 2%, that'd be just under $3,000 a month in monthly payments. I think it's $2,950 something. Don't quote me, $2,955 or something like that, if my mental math is correct. Now, if you're locking in at say just a 4%, which is actually higher than 4% on that same $800,000 mortgage, $800,000 mortgage, you're almost $1,000 more in monthly payments. You'd be looking at $30 or $900 or so dollars more in monthly payments. So if you were able to buy that same exact house, $1 million with $800,000 mortgage just a year or 2 years ago, when we were down at those lower interest rates, $900 a month is a big difference for most people's budgets, right?
100%. So when we know that there's the option of a fixed rate or a variable rate, and for some time, a lot of mortgage agents were suggesting that, or encouraging the variable rate and giving the rationale for that. With interest rates increasing and possible more increases, what are you suggesting or advising? What's your opinion on that?
So it's always comes down to the client themselves and their personal preference. I think looking historically though at variable and adjustable rates, I think it's 80% plus of the time you're going to come out ahead in paying less, whether it's less interest actually over time, even with the fluctuations. Like if you ride out the storm of increases, we're probably going to see the decreases within your 5-year term. That's what a lot of people took pre-pandemic. No one could predict a pandemic, but they were taking higher variable rates than the fixed are offering. But then pandemic hit and the prime rate dropped so significantly, then their payments, so over that 5-year period, over the next 5-year period, I think you're still going to win with that. But with the variable or an adjustable rate, yeah, 100%. But if you're someone who like can't sleep at night because you're just that's all you're thinking about is, are my payments going to go up, down? Are they going to go sideways? Can I afford this? And you just want that stability of my payments never going to change for that. Then I take the more risk adverse client and say, just even though it's more, and I think you might actually end up paying more over the course of the 5-year period or whenever, you should take it for stability, for your own mental stability's sake, right?
And let's also talk too, there's some variable mortgages, and I know there's different products out there, but there's some variable mortgages where you can have a fixed payment. It just means that if interest rates go up, then your payment doesn't change, but your principal payment does. So you're not paying down the principal. So you'd have to then look at making prepayments to kind of catch up on that, right?
Exactly. So that's the difference between when I say variable and adjustable, because a lot of people say variable, even a lot of people that go talk to just directly to their bank or someone there, and they say, oh, we have a variable rate. They don't know if it's a variable, adjustable. They kind of throw it around interchangeably a lot, but a variable rate is that static payment, right? So the payment's going to stay the same, just the principal and interest going to go up and down, which is actually going to change your amortization. So you're actually extending, that's not necessarily you are paying more interest and less principal as the prime rate goes up, but that's actually extending your loan. So it can get to a point with some lenders where you hit a trigger point where you have to make a lump sum payment or increase your payments by a certain amount because you've gone past an amortization that they'll allow. So that is a risk with the increasing Bank of Canada rate increases, right?
So I didn't know that. So that's
one of the things that people need to be aware of. And then an adjustable rate, you'll never hit that because your payments are actually increasing as the prime rate increases. So you're paying more principal and interest as that goes up.
So again, this is where having a professional help you with this stuff, a mortgage agent like yourself, right, that can explain all this, what the pros and cons are, because I think it's going to be really individual to people's occupation, self-employed versus, somebody that is living, on a fixed income, that kind of stuff, right? So many different variables there. So one last question for you. So in your opinion, with rising interest rates, do you think they help or do they hinder with inflation? Where it is right now, we've got a war going on, we've got rising food costs, we've got gas costs, we got housing affordability issues and all those other things. And we know that housing affordability may change because we're starting to see housing prices come down, year over year. We're seeing, instead of that 30% inflation, we're seeing it only at 15%. So it's pulled back 15% approximately. Again, this is all approximate numbers with some variances, but with interest rates going up, that's why they initially, as I understand it, started to make the increases, was to try and slow down the housing market, right? Which certainly has been doing that.
Yeah, so it is the rising interest rates are, like you said, not just about the housing market. It obviously does affect mortgages on a whole, but it is to curb inflation across the board in the whole economy. And as I said already, with that we talked about, that the $1 million house, $800,000 mortgage costing you $900 more a month, just with that interest rate increases over the last year, like that's 100% going to affect people's ability to buy. It might be they still qualify for that, and sure, the house is cheaper, but $1,000 more per month is what could stop them from continuing to rent and getting in or making a move, right? Maybe they're in a place and they have a fixed rate. I just looked at someone's mortgage that had a 1.6% fixed interest rate, and she was thinking about trying to do a buy or sell. I put it all together and I'm like, you can do this, but your new interest rate is going to be, more than a 1% plus higher. So we can transition you over here, and it makes sense. With your affordability right now for the next 4 years, you're locked into that payment. So, I didn't want to take a deal away from myself and a realtor that was like very excited to kind of make this move. But I said, if it makes sense for you, you can do it. And if you really want to, 100%. But that's happening in a lot of cases, right? You're seeing that affordability and budgeting for the individual person, and then thinking, if we are going to go into a recession with the rate hikes, all that sort of thing, that's what a lot of people are thinking about. And even if it does or doesn't happen, it's that self-fulfilling prophecy type thing, that the fear mongering and everything that's out there, and all the the Bank of Canada is going to raise by another 4%. I was seeing people commenting like interest rates are going to hit 8% and we're going to see all this like craziness. Even if that doesn't happen, it puts that in people's minds, and then and then less people buy, and that causes the shift in the market, right? So whether or not we do hit those things, it can definitely just skew people's minds, and then that becomes the reality, right?
Well, one thing we know is that, you know what, overall interest rates are still historically low, right? I mean, they're still very low, and they're not as low as they were a year or two ago, but certainly they are low. I mean, even comparing to 20 years ago, 10 years ago, and same with house prices, right? So either interest rates go up and housing prices go down, or vice versa. And you know, in the end, it all works out, right?
I think people have been spoiled the last 2 years with those 0.99% interest rates and things on the HSBC billboards and whatnot. And it's like, oh, now 3%. That's crazy. Where it's like, the prime rate is still lower than pre-pandemic as well right now. So we're still not even caught up to where it was from where we were before. And it took a worldwide pandemic to make those things happen. So I think it's like good we're getting back to sort of normalizing or making it more stable. Yeah. And it's all cyclical, right? So like you just said, with the housing price go up, interest rates go down, et cetera, like it will balance itself out and come back down. And that's why, again, going back to adjustable variable rates, I still think, you know, the majority of the time you're going to win by taking it, as long as you can weather those ups and downs financially and mentally, right? Yeah. Then you will come out ahead.
Yeah, and I think it's a great time for buyers to buy. I mean, you know what? There's great opportunity happening right now for them.
That's what I'm saying. I'm working with a lot of kind of investors still right now, first, second time buying their rental properties and things like that. I'm saying there's lots of opportunity. Yeah, the interest rates are higher, but let's run the numbers. The numbers still make sense. Now you're going to be getting housing in certain markets at a steal right now. And then you're going to see the average appreciation continue over the next 10, 15 years. So if you're buying and holding, then now you're going to see a dip as an opportunity, not so much as we need to back off and wait, right? So that's
100%. And there's not as much competition out there as there was a year or even 6 months ago. So, yeah. All right. So if anybody has any mortgage-related questions, where can they reach out to you? Where can they find you?
At Mortgages with Zach on Instagram. At mortgage.guru on TikTok as well. So follow me on those. You'll find link in my bio for both of those. You can book a call with me anytime directly from there, and always happy to chat.
All right. Thanks so much, Zach.
Cheers.